Good afternoon and welcome to the APTAMER Group PLC Results Investor Presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted anytime by the Q&A tab situated in the right corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to CEO Aaron Tolley. Good afternoon to you, sir.
Good afternoon and welcome to APTAMER Group's half-year results for the 6 months to December 24. So we'll kick off the presentation by doing a quick introduction to the presenting team and the company, and then we'll take a look at the financials before digging into the operational update and taking some questions. So please feel free to submit some nice and easy questions as we go along. So a quick introduction to me. So I'm the co-founder and CEO of APTAMER Group. I've got a PhD in structural biology and biophysics, and I founded the company in 2008 when I realised there was a scientific and commercial opportunity in the technology platform. I've run the day-to-day activities of the company for the past 12 years. Essentially, the company was an early promoter of APTAMER or APTAMER technology as a commercial offering, and my role broadly has been the translation of science from bench to market ready, position the company for our AIM listing, which took place in December 2021.
Good afternoon, everybody. I'm Andrew Rapson, CFO at APTAMER Group. I have over 20 years experience now as a chartered accountant. I joined APTAMER in August 22 and took on the role as CFO in August 23. And I've worked in the AIM environment now for the last 10 years.
So what is APTAMER Group? So we're a biotechnology company headquartered in York in the north of England, and we have a proprietary platform for the discovery of high-value molecules called aptamers, which are innovative, cost-effective alternatives to traditional antibodies. So our business model is essentially around solving high-value, complex problems for pharmaceutical companies and biotechnology companies on a fee-for-service basis, and then we essentially license that technology for commercial exploitation. On that basis, we try to retain intellectual property rights wherever possible, and the objective really is to generate more and more revenue from a passive income stream over time. So building this critical mass on licensable products is a key strategy that runs in parallel to generating fee-for-service revenues. So in order to do this, we focus in 3 key areas. So custom services, where we support research tools, developing molecules that support research, quality control reagents and bioprocessing solutions. We also develop reagents that can be used in diagnostic applications, such as the reagents used in COVID tests and so on. And we also work in therapeutic areas, developing molecules that can be used as delivery systems or molecules that support drug development processes for big pharma. So as a company, we have a global customer base, which includes 75% of the world's top 20 pharma companies and pretty much all of the top 10 companies. And we're recognized as a global player in a fast growing space, forecasted to grow into a multi-billion-dollar industry over the next decade, with annual growth rates estimated to be anywhere between around 20 and 28%. So this offers significant potential upside for investors. So we have 2 commercially trading platforms. So one platform is based on DNA or RNA molecules, which is at the top left-hand side of the slide. And the second, which has been more recently launched, runs off a molecular scaffold that is essentially a hybrid of DNA and proteins, making these molecules more like a peptide, which essentially combines the benefits of an antibody and an aptamer. So using these 2 platforms, we create these potentially high valuable molecules that bind specifically to targets with high affinity and are highly specific and serve as alternatives to antibodies. As a company, we've got a rich IP portfolio, around 30 patents, and we've got several others that are currently being drafted. So there's many technical advantages to this platform over antibodies, such as aptamers are faster to discover, they're smaller, they're more stable, they're easier to produce once you have a binder. They offer essentially a lower cost, more scalable manufacturing solution, and also they're animal free, which is always good wherever possible. So because our platform is in vitro, which means it runs off essentially science done in test tubes and not based on animals, we can very precisely tailor the discovery process to generate binders for specific applications, such as rapidly discovering molecules that can serve as delivery vehicles for therapeutic applications like liver delivery tools, or discovering molecules that serve as the main component in diagnostic applications, such as things like Alzheimer's tests or COVID tests. So a good way really to think of the platform is a next generation solution designed to meet the current needs of pharma partners, giving them access to rapid discovery services, with the final product having strong competitive advantages over existing platforms such as antibodies. And this is why we have such a strong and growing interest in the services that we provide. So I'll pass on now to Andrew, who will go through the finances for the past period.
Thanks, Aaron. I can just move on to the next slide. And I'll move on to the income statement. There we go. So if we look at the income statement, firstly, revenue for the half year was 0.7 million. That's an improvement over the 0.3 million we'd reported in the prior period. We continued the rebuild of revenue and started the period with a more significant sales pipeline this time than we had in the previous period, and that allowed for the revenue growth versus last year. Pleasingly, the revenue growth was sufficient to produce a gross profit of 0.4 million, at 56% gross margin, to contribute towards overheads coverage. We had a number of contracts that progressed well during the period, resulting in us delivering working binders to customers for testing and then potentially downstream licensing. We had a strong finish to the period in contract closing, and we've taken 0.5 million of contract orders through to H2 for FY25. And on that note, there's two key areas really that impact conversion of the order book to revenue, and it's worth explaining or just mentioning those briefly. Firstly, the likelihood that we'll be scientifically successful and thereby be able to complete the contract. Typically, we achieve circa 60 to 70% conversion of sales contract value to revenue. We refer to this as scientific attrition. And the second key area is understanding when target material will be delivered by the customer for us to begin work. It's not unusual for us to wait maybe 6 months for target material to be manufactured and delivered to us for us to be able to raise an APTAMER against it. It's only then when we start working on the target material in the lab that we can start recognizing revenue. So hopefully that helps to explain a little bit sometimes how we have a period of time between sales pipeline closing and then ultimately recognizing as revenue. Further to the order book, pleasingly, we've got 5.1 million of potential deals that are currently working through the sales pipeline, and 3.2 million of that is considered to be an advanced stage of negotiation now, where we've issued a proposal to the customer. We're either working through the proposal queries or we're working through the contracting process. Again, these stages of the pipeline can take little time to complete. As much as possible, we aim to retain the IP for future downstream commercialization of APTAMERs that we develop for customers. And this often means the contracting process becomes more involved than what you might typically expect. I mean, the benefits then from working through those IP discussions being the potential to generate future licensing revenues, which is ultimately the strategy that we've adopted. And it's pleasing to see the fruits of this in the period as a number of licensing opportunities has grown. If we look at the admin expenses, they reduced to 1.5 million from 1.7 million in the prior period. This reduction is a result of a leaner senior leadership cost base and a further reduction in headcount from 34 at the end of June to 28 now at the end of December. We'll continue to monitor their operating costs and have managed to reduce our overall operating cost to £3 million per annum during this period. And like we say, most of this reduction is around the senior leadership changes, but that hasn't affected the scientific capabilities within the company. Next line then is the other operating income, which has jumped up in this period. There's two income streams in there. There's a grant income from partnering on a European Eurostar project, where we've successfully delivered APTAMER binders for use in medical devices to detect placental disease. And the other element in there is rental income. So we reported in the prior period that we'd sublet part of the office space, which was part of our efforts to reduce our operational footprint, and we're seeing the benefits of that rental income with a full half-year period reported here. Ultimately then, the adjusted EBITDA loss was 1.1 million for the period versus 1.8 million for the prior period, which is mostly a result of the improved pipeline and resultant revenues generated. If we look then at the cash flow, we can see that the net cash flow from operations improved to 1.3 million versus 1.8 million for the prior period due to reduction in the cost base and improved gross profit. 949k outflow from operations was really driven by the EBITDA loss, the difference in the EBITDA loss being director fees that were paid in shares rather than cash, and so benefiting us here on the cash flow statement. There's 339k there reported as changes in working capital, and that reflects the increase in debtors that we saw at the period end. There's a significant amount of our revenue recognised through November and December, and they were coming from large pharma contracts who typically contract to us through platforms like Scientist.com and Science Exchange, where the payment terms are a net 75 days. So we had to wait until after the period end, and we've collected those debtors then in January and February after the period end. We then had an inflow of 2.6 million, which was the net proceeds from the placing in August 24, and we finished the period with a £2 million cash balance. If we move on to the balance sheet, the net assets at the period end were 2.6 million versus 0.9 at the end of June. The increase in net assets really a result of the August placing where we raised the 2.6 million that we just mentioned. This increase in net assets can largely be seen in the cash balance of 2 million there at the end of December, which increased from 0.9 at the end of June. The trade and other receivables increased by 0.5 million to 0.9 million at the period end. And as I've just covered in the cash flow statement, this was driven by a large proportion of revenue occurring through November and December, and we've collected these debtors after the period end. Also notably there, the tax receivable of 0.3 million, 0.2 million of that related to FY24, and we've collected those R&D tax credits paid by HMRC to us in February just last month, and so there's 0.1 million of that debtor then being accrued for the following period. Most other elements on the balance sheet were largely similar to what we've reported in the prior period. So that concludes the financial review. I'll now pass you back over to Aaron to take us through the operational review.
Yeah, thank you, Andrew. Can we just pop on to the next slide, please? Yeah. So just as a brief reminder, we refreshed and restructured the board in August 24. So as I've introduced myself, I'm the CEO, having founded the company with Dr. David Bunker, who's the fellow in the middle there. Andrew's already introduced himself, so that leaves Adam, who's our non-exec chair. So Adam's a registered pathologist and an expert in preclinical drug development. So you can imagine where Adam's interest is in the business. And Adam worked for AstraZeneca for over a decade before setting up his own pathology consultancy service. Tim is the second financial expert we have on the board and has broad experience in the AIM environment, having been both a CFO and a CEO in that context. And the board is essentially restructured with a focus on streamlining APTAMER both financially and to renew the focus on developing and exploiting licensable assets, and essentially to structure the business for generating passive income from that strategy. And I have to say, it's been a pleasure working with this team. They're fully aligned, fully focused, and I'd like to think that we're making really, really good strides in the right direction with building steady progress. And I think it's worth pointing out that we're a very hands-on and incentivized team. We're in contact daily and are completely focused on returning shareholder value. So if we to change the slide, please. So this is an update on the fee-for-service development. So over the past 6 months, we've signed 4 agreements with top 20 pharma companies, mainly around critical reagents, which effectively would be used to support drug development activities within pharma companies. We've extended a past successful contract with another top 20 pharma partner to essentially optimize an existing project in the bioprocessing space, which will be used going forward as part of their kind of efforts. We've also signed several of the smaller deals with biopharma and biotechnology companies in a range of different areas. The project, which is quite interesting, with the unnamed genetics medicine partner, progressed to the next stage following customer validation of the binders, which will be used for drug delivery. So in short, they tested our aptamers in their own labs and demonstrated functionality. We've also successfully completed our project, developing binders for non-invasive prenatal screening for placental diseases. So this binder or binders can form the basis of a diagnostic kit, and we now have significant interest from top biotech companies who are evaluating the technology in their own labs, with good success, I might add, with a view to licensing. Another successfully delivered crop of projects is around enzyme modulation, which we haven't really discussed before, and it's relatively tricky to explain, but I'll have a go. The best way to think about enzymes is they're workhorses for processes used routinely in life sciences, and they can be used for manufacturing of materials or as part of kits used to diagnose diseases. So they're very versatile molecules. And generating binders that can modify or modulate enzyme function can essentially program these enzymes to work more efficiently and to have better performance characteristics in certain applications. So here we've generated a suite of binders that essentially offer performance advantages for enzymes used for things like next generation sequencing and gene synthesis. So these products have been evaluated externally. They've been shown to work by external partners and have very high performance. And so licensing discussions are underway in several areas. And finally, we have a pipeline update. So I think while pipelines can generally be seen as nebulous concepts, our pipeline, in my opinion, should be thought of as a window to these high value opportunities, not just necessarily a tool to assess fee for service revenue. So movement in the pipeline, and specifically accumulation of deals in negotiation, as Andrew touched on, is therefore a measure of progress. It's a critical measure of progress, actually. As discussed at the last update, we've restructured the sales team to focus on pipeline build. And I can report that we've added around $1 million to the pipeline since the last report, and it now stands at approximately about 5.1 million, with importantly 15 or so opportunities in late stage discussions, most of them, as Andrew pointed out, currently under contract review or moving towards signature. So could we move on to the next slide, please? So this slide really exemplifies the high value assets that have been driven from the platform. So I've got a brief update on each of these areas. So these are opportunities that have turned into 3 potentially high value IP based licensing opportunities. So if you remember the opportunity with Unilever, this was where we developed binders that can be used to treat malodor or body odor by essentially silencing the bacteria that live in the armpit from making bad smells. This obviously has huge transformational potential for the company. So in terms of an update, we've extended the contract in September 24. Skin testing was initiated, which is the next phase of development, in December 24. And we've shown the aptamers are stable over 48 hours in skin samples, which is a great kind of time point from a deodorizing point of view. So essentially all the work is complete from our side, and we're currently waiting for the lab tests now at Unilever. So the project is currently working, it's on its way through their system. One update here is, and you can hear it from me here first, we're now working on our second contract with Unilever on a separate project we're currently negotiating legals on, and I do look forward to updating you all on that in due course. So secondly, we move on to NeuroBio. So if you remember, this was around developing a diagnostic test for detecting early stage Alzheimer's, potentially 10 to 20 years earlier than symptoms occur. So I'm pleased here to report that our binders have now been validated in clinical samples to the highest level of validation possible. And we're now working, led by our partner company NeuroBio and Baroness Greenfield, on a larger clinical study to validate the diagnostics as we speak. So internally, we've demonstrated successfully the first iteration of an immunoassay, which is designed to work on the type of clinical analyzers that are installed in most hospitals and test centres. The idea here is to work on a format that will obviously have the most market traction and penetration possible when developed and launched as a product. I'm obviously looking forward to updating on that as progress unfolds. And then lastly, we come to the liver fibrosis. So this is an area where we're looking at using our technology for delivering drugs to specific cells. And one of the main challenges in drug development is that, in essence, delivering molecules very selectively to certain tissue types. And we focused here on fibrotic tissue and liver in particular to address an unmet need and essentially align our platform with current requirements in the drug discovery space. So I'm pleased here to update that the deal signed with AstraZeneca in July 24 has been successful scientifically, with the in vitro, which is essentially the lab-based portion of the work, being complete. And this links through to our in-house data based on the delivery of siRNA molecules to the same cell type. And this time we've delivered, we've essentially coupled siRNA molecules that have the capability to silence molecules associated with fibrosis. And we've demonstrated that we can deliver those to the liver cells selectively. And these essentially show promise in reversing markers of fibrosis. So this, when you combine with the recent success with the genetics medicines company, which was another delivery project that we've had externally validated, this gives us lots of confidence that we should now progress to what's called a pivotal animal study, which is where we would demonstrate the functionality in an animal model. And this will essentially then give us the data to enable discussions to move towards more therapeutic type deals that you're used to seeing with companies that are engaging in this type of work with large pharma. So if we could just move on to the next slide, please. So as previously discussed, the business model is to generate fee-for-service revenue. So one of the important things to note here is this increased number of licensing opportunities. So the general model here is to do fee-for-service work and have that turn into IP-based licensing opportunities that can underpin essentially the cost base of the company. So on the last slide, I discussed at length these 3' assets that sat alongside a smaller licensing opportunity in critical reagents, which is why the number is 4 and not 3. But I'm pleased to report that since the last time we gave an update, we've now completed development of several other assets and started commercial discussions regarding their licensing. And I touched on these earlier on previous slides. So 3 assets in enzyme modulation. There's APTAMERs for early stage fetal diagnostics, and 2 additional assets in the delivery space. The important thing to note here is the expansion of the licensing opportunities over the past 6 months from 4 to 10. And this brings us closer to tipping the balance towards generating some form or generating passive income to supplement our fee for revenue stream. So in my mind, this is a portfolio-based play with validated technologies, essentially waiting in line for negotiated licensing deals. So if you look at the type of deals that we're presenting here, any one of these could potentially be transformational to the business, given our 3 million cost base. Now, I'd love to be able to give more clarity on exact timelines for all of these, but that's obviously very challenging to do. But what I will say, and potentially go out on the limb, is that we expect some of these to materialise before the year end. But if they don't, and it takes a month or so extra, that's not necessarily to be seen as a bad thing, because it literally makes no sense for the long-term growth of the business to take a poor deal, to force these agreements into a particular reporting period. And I personally don't think it's in the best interest of the shareholders to do that. So if we can move on to the next slide, please. So this is really just a wrap up. And in summary, I'd like to leave you all with 4 key take-home messages. So this is a platform that we've developed for growth. The platform targets a $210 billion market for affinity ligands. We have the foundations and we've got the relationships with all of the top 10 pharma companies, 75% of the top 20 global pharmaceutical companies, demonstrating the need. We're moving these through to working products and through to licensing negotiated deals. And we've developed several additional assets, leading to 6 more licensing opportunities in our licensing pipeline. And we're really focused on the business models to secure IP and leverage these potentially lucrative IP-based licensing deals. So the board and the management team are working really hard to deliver these opportunities in news flow, and we look forward to updating shareholders as soon as possible with exciting news and more updates. So that essentially concludes the formal part of the presentation, and we will now move on to any questions that you may have.
Aaron, Andrew, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do so just by using the Q&A tab that's situated on the top right-hand corner of your screen. We have received a number of questions, and I want to start the Q&A session off with this one here, which reads as follows. How do you see the company dealing with the added volume of work should lucrative contracts materialise from your visit to the US?
Yeah, that's a good question. I don't mind taking that one. As you say, our visit to the US was extremely productive. We've met with existing customers, we met with potential partners, and we've essentially discussed everything from the potential application of the technology in proteomics-based platforms all the way through to radioligand discovery and delivery. So essentially, we have the capability and capacity within our current team to deliver our current sales pipeline and any additional opportunities that may have come from that trip to the US.
That's great. Thank you very much, Aaron. Turning to the next question. Given the strong opportunities of £5.1 million, does APTAMER have enough funding to deliver the potential revenue from this pipeline?
I'll take that one, Aaron. In a word, yes. We think we do have enough funding. The timing, as I mentioned when I was talking through this, the timing of the pipeline conversion is hard for us to predict, and contracts do take time to negotiate, particularly where we look to retain the IP. But as Aaron touched on, that's where we see the value here in the business. So as much as possible, we'll continue to look to retain that IP. The pleasing thing about that 5.1 million pipeline is that 3.2 million of it is advanced stage. So we're hopeful of conversion of an element of that over the coming months. And the company has sufficient funding to allow that bit of the pipeline to be converted, and we'll look to do so. And any of that conversion then will just further extend the runway that we've got. And as I mentioned, we've got £2 million in the bank at the end of February, so we've got a good runway from where we stand today.
That's great. Thank you, Andrew. The next question here. Why is there a significant time frame between contract signing and the start of revenue recognition and cash flows?
You want me to? I don't mind taking that one.
Yeah.
It's generally down to the complex nature of the opportunities. So in some situations, you can have several weeks of in-depth technical conversation with the customers to fully understand the problems that they have, develop a solution to them, and then you effectively have to build a pitch deck. You have to present to the technical stakeholders within the business the solution, and then it has to go through the buying chain internally. And that, with bigger companies, can just take a bit of time to agree. On top of that, because we look for upfront cash on our deals, and we look to maximize value long term with the IP, that can then have some impact on conversations with the legal teams within those businesses. So things can just be a little bit protracted because we're aiming to get the best deals we can for the company. And I think that's probably as much as I can add to that. It's just we could do shorter timeframes on the deals, but then we wouldn't be having and getting the best deal for the business.
Thank you for that, Aaron. The next question is really around cash and asks, how long is the cash runway on the current position?
Okay, I'll go into that in a bit more detail. So as we've mentioned, there was 2 million in cash at the end of the period, and we've still got 2 million in cash at the end of February, having collected on those year-end debtors and having collected the R&D tax credit. The cost base now is circa £3 million per annum, so £250,000 a month. So on that basis, that £2 million will last 8 months. So that would take us out to October time. and that's assuming no revenue. And clearly, we're not in a position of no revenue as we stand today. We took 0.5 million of contracts through that are going through the lab into this current period, and we've got particularly that 3.2 million of late stage negotiation pipeline that we're currently working on closing, and we'd expect a healthy element of that to be closed during this period towards the end of this financial year. So there's lots of opportunity there to extend well beyond the end of October. So that's all the numbers, I guess, and that's as much as we can say. That we're confident in the runway that we've got. We've got sufficient to see us to the end of October with no revenue, but clearly we've got revenue coming through, and that'll all add to extend that runway further.
Understood. Thank you very much, Andrew. The next question here: have you managed to hit your cost reduction target?
Yes. So yeah, we touched on this. We did a significant cost reduction in FY24, where we took all the quick wins really, and we've managed to take a few further reductions around the time of the placing, restructuring the senior leadership team, and reducing the headcount ever so slightly. So we're now down to that £3 million per annum cost base. And that provides us a lean cost base. It reduces the pressure on the cash reserves, as we've just talked about, and helps to maximise the runway there. Any further cutting of the costs, I think, would be potentially compromising the skills base within the business. But the structure that we've got now has not compromised our scientific capabilities and will allow us to deliver that sales pipeline that we're looking to convert.
Turning to the next question, have you managed to find any further opportunities in the consumer goods space for APTAMER use?
Yes, in short, and as I kind of alluded to in the presentation previously, and that we are currently in negotiations for a second project with Unilever in that space, and I'll update, or we will update in due course on that.
Perfect. Next question here: how far progressed are the licensing discussions for the enzyme modulating optimers with Big Pharma?
They're pretty well discussed. They're at different stages of advancement. So we have some where we're at heads of kind of agreement stage, where we're kind of working on fleshing out the terms of the deals in terms of royalties and upfront payments. And then we have others. Another one is undergoing technical evaluation in the labs with that particular person. We're meeting fairly soon with their business development team to discuss potential licensing arrangements.
Thank you very much. The next question is really around growth, and asks what your strategy is for the next 18 months in terms of growth.
Yeah, I think we've recently hired 2 new business development executives or business development managers, one of whom started last week. So we're just going to really focus on growing the sales pipeline and converting the sales pipeline into revenue, essentially, to underpin the kind of cost base. We'll also continue to focus on progressing the liver fibrosis projects, the Alzheimer's disease, and as far as we can have influence on it, the work with Unilever for the deodorant project, but also these enzyme modulation opportunities. That's something that we're going to look into a bit more detail, because we think we found a really sweet spot, essentially, for the platform to operate.
Thank you very much, Aaron. And the next question here: how will APTAMER deliver shareholder value?
I think by keep doing what we're doing, plugging away, keeping the cost base as low as possible, and focusing on revenue generation and switching to get more and more income from these licensing streams, which will essentially be 100% margin. And the more licensing revenue we get, the less dependent on fee-for-service revenue the company becomes. And this whole concept of passive income generation is really where we're going to focus to try and underpin the business and get as close to kind of break even as we can with that licensing revenue.
Perfect. We have another question here. When will the fibrotic liver asset be tested in an animal model? And is there intention for AstraZeneca to take this forward? And in the future, could AstraZeneca pay for this?
That's a very good question. So the lab-based part of that work has been successful, and we've shown selective delivery of AstraZeneca's siRNA to the fibrotic liver, and we've demonstrated what's called knockdown in that tissue. The intention really will always be to move this into what's called preclinical studies. So we really need to demonstrate the functionality of these molecules as a delivery vehicle in an animal model. So we're currently discussing with multiple centres the best models and the best animal systems to use in order to get the best, most accurate results at this preclinical stage. But once we've found the best partner, we'll be focused on moving forward, and we'll announce that as we go along. But we're also progressing this asset, the asset, with further in-house studies. So as I mentioned in the presentation, we have found some siRNAs that demonstrate ability to reverse markers of fibrosis. So again, this is in line with our business model, and interestingly, we retain the IP wholly on this asset. So we've got multiple large pharma partners really interested, actually, and a few small biopharma companies globally in the fibrotic liver delivery vehicle. But we have a few steps to go as a company. We need to prove the system at a preclinical stage. We need to get some evidence in animal models that it's functional. And once we've done that, we'll be in a much stronger position as a company to negotiate higher value deals and better quality deals with these big pharma companies who are interested.
That's great. Thank you very much, Aaron. You have answered a number of questions, so maybe time for just a couple more. This question here on the APTAMER platform: how does the APTAMER platform compare to traditional antibody solutions, and how is this differentiation helping you win market share?
How does it compare? Well, we like to think that it's a better system. As with all platform technologies, it has pluses and minuses. Aptamers and optimers will be better at certain applications, and vice versa with antibodies. The key really is to find those niche application areas where the platforms excel, which is why you have platform technologies like macrocyclic peptides and other recombinant antibody formats all finding their kind of niche area. For example, there's ranges of what are considered to be undruggable targets, where which are natural nucleic acid binding proteins or RNA binding molecules, where small molecules and antibodies really struggle to have a druggable effect on those molecules. So if you think about aptamers or optimers being nucleic acids, they're obviously a better kind of natural molecule to serve as drug compounds to activate or inactivate those targets.
That's great. Thank you very much. And just the final question on the same theme: how is the APTAMER platform developing in terms of overall interest and/or for forward demand for prospective clients?
I think it's developing really well. We've got 3 platforms or 2 platforms. So we've got a DNA-based platform and an RNA-based platform, and then we have this platform called APTAMER Plus, which is essentially the hybrid molecule between a DNA and peptide. So it essentially has a DNA backbone and it has amino acid side chains, which is a very technical answer, but ultimately it kind of bridges a gap somewhere between a nucleic acid aptamer and an antibody. So when we're offering these services to different customers, there's obviously different application areas that each of the kind of platforms that we have speaks to, and we're seeing pretty good interest in them because of the benefits over antibodies. One of the key areas of interest at the moment is looking at the molecules as potential delivery systems for things called radioligands and radionuclides. So that's targeted radiotherapy delivery, and I'm fairly confident that there'll be some updates in that space in due course.
Perfect. Well, Aaron, Andrew, thank you very much for answering those questions from investors. Of course, the company can review all the questions submitted today, and we will publish out the responses on the Investor Meet Company platform. Before redirecting investors for their feedback, final thing to do, Aaron, if I could just ask you for a few closing comments, that'd be great.
Yeah, I think I spoke quite a lot today, so I'll keep it very short. But as always, I appreciate people taking the time to listen. Thank everyone for their time and their ongoing support in the company. And we'll look forward to kind of working hard and producing news flow to give you all updates and give you updated progress on all the different areas we're working on.
That's great, Aaron and Andrew. Thank you very much for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but some should be greatly valued by the company. On behalf of the management team of APTAMER Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.